Yeah, it's great to be back. So we're here with Borja Clavero Ugarte, who is going to talk about the nature of current accounts and what allows banks to create money. So this should be quite interesting to go into the details. And yeah, Borja is also an acolyte of Professor Richard Werner, and it's great to learn more about the details of how the economies of the world really work. So with no further ado, Borja, please take it away.
It's a pleasure to be here. My name is Borja Clavero. I'm a PhD candidate at Montfort University in the UK, under the supervision of Professor Richard Werner. I'm also CFO at Valhalla Network, and at the same time I work as a consultant in the banking and paytech industries, helping banks and e-money institutions get a license from regulators. Let me start with the results of a survey that was carried out in Austria 2 years ago. This survey is, by the way, very similar to an earlier one Professor Werner himself did in Frankfurt. In the case of the Austrian survey, the respondents were asked, how is money consisting of cash and deposits created? 4 out of 5 respondents said, and I quote, the central bank prints it. In the same survey, when asked, how are bank deposits and cash backed? 68% responded, they are backed by gold. So let me repeat that. 4 out of 5 think money, including deposits, is created by being printed by the central bank. And 68% think money is backed by gold, by which I guess they mean that for every euro of deposits and cash, there is 1 euro of gold somewhere. We have an educated audience here. As you know that these responses are wrong. Cash represents only a tiny fraction of the total money stock, and gold cannot possibly back deposits, because for every euro of gold, there are roughly 20 euros in current accounts. So this is what I'm going to be covering in the next half an hour. We're going to see what the law has to say about current accounts, and as you'll see, they can be understood as loans with special characteristics. I'll show you why it makes good sense that people think that they own the money in their bank account, and I'll show you that it is those very properties that create that illusion. Finally, I'll be discussing what constraints banks face in their capacity to create money, and I'll end by discussing some implications. Before I begin, I should say that the reason I find legal analysis so useful and attractive, and Professor Werner has pointed this out, and in fact, he's the reason why I turned to this approach, is that finance is ultimately about financial contracts, and financial contracts are ultimately about law. That is to say, in economic and financial affairs, reality is human-made. So any ontological claim about what there is can be answered very clearly by means of analyzing the underlying contracts and applicable laws. To put it differently, unlike physicists who have to decipher nature and invent a language on the go to do so, financial reality is much more amenable to interpretation and description, for it is human-made. This gives us great advantage over scientists in other fields. It means we can reach conclusions about the nature of reality and be confident of their validity. Also, I should clarify that I'm going to be using mostly English common law cases. England is where modern banking law was invented and took root, and English legal doctrine has been dominant in the evolution of banking and payment systems, and underpins banking laws across many countries around the world. So let's start. So what is a deposit, legally speaking? It has long been established that a deposit is a loan to the bank. The earliest judgment on this is from 1848, in a case known as Foley v. Hill, where the House of Lords held that the banker-customer relationship was essentially a debtor-creditor relationship. Let me quote Lord Chancellor Cottenham. Money placed in the custody of a banker is, to all intents and purposes, the money of the banker, to do with it as he pleases. He is guilty of no breach of trust in employing it. He is not answerable to the principal if he puts it into jeopardy, if he engages in a hazardous speculation. He is not bound to keep it or deal with it as the property of his principal. But he is, of course, answerable for the amount, because he has contracted, having received that money, to repay to the principal, when demanded, a sum equivalent to that paid into his hands. End of quote. Many other court cases since then have reached the same determination, and by now there is widespread agreement among legal scholars. I could show you 15 quotes like this, but I won't. When a depositor places funds with a bank, it owns a claim on the bank, and the bank has the obligation to return the equivalent amount of funds when demanded by the depositor. The bank does not hold the funds in custody under a trust or bailment. The bank can and does use the funds deposited for its own purposes, for example, to invest in loans and bonds, and the funds received from depositors are commingled, that is, mixed, with the bank's own funds. Accounting standards, of course, reflect this reality, and deposits are treated as the debt liabilities of banks and recorded on their balance sheets. The depositor holds a debt claim on the bank, and the bank promises to repay the equivalent amount of funds on demand, that is, upon instruction by the depositor to withdraw or transfer. Deposits are then a particular sort of loan, a loan that is unsecured, has no debt covenants, and can be called back by the creditor without prior notice. Current accounts have another interesting property, which I call the transferability by innovation clause. What this is essentially the possibility of transferring funds from one bank to another without any legal hassle. Think of how difficult it is to transfer bonds from one issuer to another. We know other financial instruments do have this property. For example, credit default swaps can be novated. But what makes current accounts stand in a category of their own is that novation occurs instantly, on demand, and routinely every day on a massive scale. Let me explain this using the accounts. Suppose Makoto were to transfer 200 euros from his account at Deutsche Bank to Ben's account at UBS. These T accounts only show the cash leg of the transaction, by the way. When the transaction is over, Makoto's claims on his bank would have been reduced by 200 euros, while Ben's claims on his bank would have been increased by 200 euros. Now, everyone, including the literature on payment systems, would refer to this as a transfer. But this term is grossly inadequate, as some authors have pointed out. The reason this can be called a transfer is that the thing that Makoto was holding is of a very different nature to the thing that Ben receives. Makoto had a claim on his bank, and if his bank were to go insolvent, he would qualify as an unsecured creditor, and the administrator would administer the sale, realization, and distribution of the residual pool of assets according to the pari passu principle. Makoto is therefore exposed to credit risk, the risk of insolvency of his bank. But this credit risk cannot possibly be the same as the credit risk to which Ben is exposed, for the probability of default of UBS cannot be exactly the same as that of Deutsche Bank. This operation, which we carry out every day, creates an illusion. It feels as if we actually own the funds, that we are in control of the funds that move between banks, i.e. reserves. I call this the illusion of double usability, because it gives the impression that both the depositor and the bank are in control of the funds. This is why it is so intuitive to think of banks as custodians of our money. This also explains why money creation is not understood by ordinary people. And when the mechanics are explained to them, they often refuse to believe it. It feels like cheating. So let me turn now to why banks can create money and other financial institutions cannot do it. In order to do this, I'm going to compare two types of financial entities, credit institutions and e-money institutions. For those who are not familiar with this, think of Revolut in the UK or PayPal in the EU. Now, like banks, e-money institutions issue a liability that is commonly used for payments, that is e-money accounts. According to some estimates, e-money is around 0.1% of M1 in the euro area, M1 being the monetary aggregate defined as currency and deposits. And in countries like Luxembourg and Lithuania, around 5% of total payments by non-banks are made by transferring e-money balances. As you can see in the slide, both deposit accounts and e-money are recorded as a liability on the balance sheet of the issuers and represents a debt claim of account holders on the issuers. In one of his papers from 2014, Professor Werner put forth the proposition that for an entity to be able to create money, it is a sufficient condition for money to be recorded on its balance sheet as a liability. Although I find that paper illuminating, I would disagree with this. And I would say that under certain conditions, money can also be created off balance sheet. But let me put this to the side because it is too technical an issue to discuss here. If we stick to normal cases, on-balance sheet recording of money is a necessary condition, but not a sufficient one. That is to say, other factors need to be present to explain whether an entity can create money. These other factors can be discovered by comparing credit institutions and e-money institutions and looking for regulatory differences. When we do that, we realize that even if both entities issue money, only credit institutions can create it. And by creation, I mean issuing funds in current accounts in excess of the funds received from account holders. So let me compare the business models and regulations of both types of entity. Let me start with e-money institutions, which have been mentioned by Makoto earlier. Their business model is quite simple. They issue e-money liabilities, which can be used to make payments and act as principals of account holders and make payments on their behalf. A customer loads his e-money wallet by transferring funds to it from his bank account. The e-money institution records the funds received as its asset and issues e-money liability, for the same amount. This is critical. By law, for every euro of e-money they have issued, e-money institutions have to hold €1 of funds in what are called safeguarding accounts. This makes sure that Just make sure that they keep a 1-to-1 ratio or parity between the two. The reason for this is that regulators recognize e-money holders as unsecured creditors, and this mechanism ensures that there are enough funds safeguarded for distribution if the situation arises that the e-money institution becomes insolvent. Regulations also restrict the amount e-money institutions can borrow, so that the account holders do not fall by the wayside when competing with other creditors for the residual assets of the insolvent entity. On top of that, e-money institutions are forbidden from making loans to account holders, except for very small short-term loans when these are connected to the settlement of customer payments. So the balance sheet of e-money institutions is quite simple, as shown here. Notice the parity between e-money and safeguarding funds. Notice also that the e-money institution must keep its own funds separate or segregated from the funds held on behalf of customers. And it is forbidden from using those safeguarded funds for its own purposes. It must observe the parity rule at all times. Now, let's compare with credit institutions, which we know create money by giving loans. We have to look at what specific regulations allow them to do that. Remember, both banks and e-money institutions issue a liability which is widely accepted in payment. While e-money institutions can only issue e-money when they have received money from account holders, credit institutions can create current accounts under a much wider set of circumstances. This can be appreciated in the very way they are defined. They are the legal entities in the business of taking deposits or other repayable funds from the public and granting credit on their own account. That is to say, unlike e-money institutions, credit institutions are not forbidden from making loans and do not have to observe the parity rule. That is, they can use the funds received from depositors for their own purposes, for example, to grant loans. As long as they can meet customer withdrawals, they are free to manage the amount of funds they keep to meet those withdrawals. This is why the balance sheet of banks looks the way it does, with reserves being a small percentage of total assets and deposits being quote-unquote backed, mostly by loans and to a lesser extent by securities. It follows that current account balances must have been created by transactions other than customer deposits, that is, through other balance sheet counterparts. Very differently, for an e-money institution, e-money will only be issued when it has received funds from the account holder, so the total amount of funds in the hands of non-banks stays constant. Banks, on the other hand, can disburse many types of payment obligations by crediting current accounts, which includes not only the deposit of currency, but also loan disbursements. Nothing stops them from doing so. Nothing, that is, besides the borrowers rejecting that mode of discharge. I'll come back to this later. Notice also that loans are not the only way money is created. The maturing of long-term liabilities also creates money. It follows from simple accounting rules. Let's see how it happens. By the way, whenever I see these balance sheets, I'm reminded of that quote by Kenneth Galbraith that the simplicity of it all seems indecent. The following tier accounts are a simplified version of the empirical test performed by Werner in 2014. Werner borrowed 200,000 euros from a small bank in Germany, and he inspected the internal accounting records of the bank to see the origins of those funds. He showed the obvious. The funds did not come from any other account, either externally or internally. They were created out of nothing on the spot. The bank offered a liability in payment, and since that liability is widely used in payments, Werner accepted that mode of discharge. As I have explained, there is nothing illegal about this, and this is the ordinary business of banks. We can think of it as follows. The bank told Werner, "We could disburse the loan in cash, but since the amount is quite high, I hope Mr. Werner will agree that this would be highly inconvenient, and that it would be far more advantageous if Mr. Werner deposited the cash with us and we credit his account. In fact, let's skip that unnecessary step and proceed to credit the account directly." We as borrowers, society as a whole, do not refuse that tender by banks when we borrow from them. In fact, we don't even think about it. We are being offered a liability in discharge of the payment obligation. The bank transfers nothing to us. And yet, in 99% of cases, we accept that tender and declare that mode of performance satisfactory. So the question is, why do we accept that tender? I have written about this elsewhere. Basically, my argument is that the ability to transfer deposits by innovation is a key factor for the following reason. When the bank issues a liability in payment, we incur credit risk. We hold a claim on that bank. We are its creditors. As a palliative, the bank allows us to transfer the liability to another bank instantly and directly, giving us some protection. If we suspect the bank is in financial trouble, we can always quote-unquote transfer our account balances to a healthier bank. Remember that this is not strictly speaking a transfer, but a extinction or reduction of one type of claim and the concomitant creation or increase of another type of claim. Other factors like deposit insurance schemes and the ability to pay taxes give current accounts an official imprimatur and make them an attractive financial instrument, even though they pay so little interest. But I believe it is the transferability by innovation that is the most important factor and why these instruments have so much utility. Remember, innovation creates a direct route between the liabilities of different entities. Instead of redeeming the liability for cash and using that cash to buy the new liability, you can transfer the liability directly from one issuer to another, skipping the intermediate step and breaking the reliance on cash. Innovation makes current accounts stand on their own. Let me now turn to something Makoto asked me to talk about, and that is the question of what are the limits to money creation? That is, what prevents or constrains banks from creating an infinite amount of money? First thing to recognize is that the banking system is highly elastic, and banks can create huge amounts of money if the conditions are right. Banking crises and deep recessions are often preceded by a boom in bank credit. In this graph, you can see bank credit in the euro area, booming before the crisis and then contracting sharply afterwards, leading to misery and devastation for a number of years, some cases decades, like in Japan in the 1990s. We know self-reinforcing cycles exist. This is especially true when bank loans are collateralized by assets with inelastic supply, like real estate. When banks give mortgage loans, new money is chasing a stock of assets, the supply of which is slow to adjust, and which is essentially fixed in the short run. What gives is not quantity, but price. So banks give mortgages, pushing up asset prices, and since those loans are collateralized by the very thing the funds are being lent to purchase, a rise in collateral values incentivizes banks to lend more against that collateral. For those of you who are not familiar with this, I recommend you check out Professor Werner's book, New Paradigm in Macroeconomics, where he explains all of this in detail. So what factors and regulations limit banks' ability to create money? There are several, but let me first make two clarifications. First, let me state the obvious. What banks do is quite different from what a professional counterfeiter does. A counterfeiter is looking to create assets for himself by producing fake banknotes. Banks, on the other hand, create liabilities. So the two operations are very different. Second, regulations typically do not determine nor directly influence the growth rate of money. In the 1980s, under the influence of monetarism, central banks did try to set money growth targets and used reserve requirements and open market operations to achieve them. They failed miserably. There are other historical episodes where more direct controls were imposed on banks. For example, the Bank of Japan practiced this window guidance policy in the 1970s and 80s, whereby it set loan quotas that banks had to fulfill each quarter. There are other examples of this, like credit controls in France, the corset in the UK, but today these policies are no longer in place, at least that we know of. The growth rate of monetary aggregates plays very little role, if any, in the policy frameworks of most central banks today. In the case of bank regulations, broadly speaking, they take the form of capital requirements, liquidity requirements, both part of the Basel III framework, and to a lesser extent, reserve requirements. Under Basel III, banks are required to hold a minimum amount of capital as measured as a percentage of risk-weighted assets, their capital ratios, and as a percent of total assets, the leverage ratio. As a rule of thumb, the total capital ratio must be greater than 8%, and the leverage ratio must be greater than 3%. Banks are also required to hold additional capital, what are called buffers, like the capital conservation buffer, currently set at 2.5%, the counter-cyclical capital buffer, currently at 0.5%, and other buffers imposed on big banks called systemic risk buffers. Now, banks can replenish their capital in two ways. They can generate profits and build up retained earnings, or they can sell shares and subordinated bonds to investors. Now, do capital requirements influence money creation? The answer is yes, but only in a rather indirect way. The reason is quite simple. When banks create money, that money circulates in the economy and can be used by investors to purchase shares newly issued by banks, destroying money in the process, by the way. The following graph shows the evolution of money and all its balance sheet counterparts. On the positive side, assets create money. On the negative side, liabilities destroyed. So when the banking system as a whole sells capital to non-banks, the investors use the funds they hold in account with banks to pay for those shares. Effectively, what happens is a swap of one liability for another. Normally, this happens in a diffuse way, and borrowers are not the same people who buy shares from banks. This is because company law in most countries forbids banks from giving financial assistance to borrowers for the purpose of buying their own shares. There is a little dirty story, and I'm relying from evidence dug out by Professor Werner. The story is as follows. During the global financial crisis, the UK bank Barclays was short of capital. Being in difficult times, he could not find willing buyers for its shares. So he did the following. It approached a big sovereign wealth investor from the oil Gulf, and it offered the following deal. It lent £8 billion to the investor, creating money out of nothing, and then it simply swapped the money for its shares, a liability swap. In other words, it created money, and the money was used to buy its own shares. As I said, this operation is forbidden by Companies Act in the UK, but it shows what latent power banks have. In the case of liquidity requirements, they take the form of two ratios that banks must fulfill, the net stable funding ratio and the liquidity coverage ratio. Both of these ratios must be greater than 100% at all times. I'm not going to explain the formulas behind these ratios, but I will just say that they ensure that banks have enough liquidity at hand to cover deposit withdrawals. I should say that none of these regulations contain any mention of money creation and are not intended for that purpose. Instead, Basel III ensures that banks are healthy and can withstand losses and bank runs. Finally, let me say something about reserve requirements. In traditional economic textbooks, reserve requirements were supposed to be a strong constraining factor in the money creation capacity of banks. However, in recent decades, many authors have pointed out that this supposed mechanism is not there, and if it was ever there, it has long ceased to be relevant. Many economists have called the money multiplier misleading or flawed or worse things. Without going much into the details, there are two reasons for this. First, the way reserve requirements are calculated is backward-looking, which means that banks create money first and then look for ways to comply with the reserve requirements. Second, central banks supply as many reserves as banks need, provided that the banks post adequate collateral. The reason for this is that restricting the amount of reserves would destabilize short-term interest rates, as happened during the monetarist experiment during the 1980s, as banks bid each other for scarce reserves. Third, many countries have abolished reserve requirements in the last decades. The central banks of Denmark, Norway, the UK, Australia, New Zealand, Mexico, Canada, and Sweden currently do not impose reserve requirements on their domestic banks. On the other hand, even in countries with no reserve requirements, banks do voluntarily hold reserves, as these are needed to settle interbank payments in a safe way. For example, during the day, central bank balance sheets expand greatly due to intraday credit, which is granted to banks by the central bank in unlimited amounts, provided again that the banks post adequate collateral and after the application of a haircut. It can be argued that collateral constraints and haircuts may limit the expansion of bank balance sheets and money creation. Unfortunately, to my knowledge, this question has not been explored in the literature, so I can only speculate. Finally, I'm not going to go into this, but there are natural limitations to how much money can be created, and those are the profitability of loans and whether there is enough demand for loans. It takes two to tango, so if there are no willing borrowers, loans cannot be given. Also, banks need a sufficient spread between loans and deposits to lend profitably. So, to conclude, as we have seen, the depositor-banking relationship is one of debt, that is one where the depositor is the creditor and the bank is the debtor. The banks receive funds, and the funds belong legally and beneficially to them. They owe only a debt to depositors, a debt that must be satisfied on demand if demanded. That debt has the property of being transferable by innovation to other banks, and as I have argued, this is one of the reasons why we accept liabilities in payment when we borrow from banks. Strictly speaking, banks don't lend money because you cannot lend a liability. Banks don't take deposits. If by deposits we mean what ordinary people think by that word, that is a relationship of custody or bailment, where the bank keeps the funds and is responsible for their safekeeping. Finally, while it is true that banks don't need deposits at the moment of granting a loan, they do need the reserves that those deposits bring to settle the interbank payment that follows the transfer of the deposit to another bank by the borrower. Thanks.
So yeah, it's really great. So there's quite a lot of questions that people had based on these details regarding financial crises. So because of the way the banking system works and it's lending money potentially to buy assets that are then collateralized to give more loans, does this mean that financial crises are actually artificially created?
Well, artificially, I wouldn't say artificially. I mean, it's not that it exists in the mind or something. It's actually happening, but they are avoidable, and they have the causes. Their causes are pretty straightforward. Maybe not in all cases, but in many of them, 90% of cases, and it has to do with just too much bank lending for the wrong purposes. And Richard Werner would tell you this. I think the data is pretty consistent with this, and the findings in the literature are consistent with this. But I wouldn't say they are artificial. I mean, it's just that it's just an inflation of asset prices, and this leads to the self-reinforcing cycle I talked about. And in itself, it's artificial in the sense that it is driven by nothing. It is not driven by GDP growth. It's driven by something else. Banks creating money for financial transactions, and this is pushing asset prices up.
What is the role of interest rates? So you didn't really mention this so much, but the, of course, mainstream view is that interest rates are the driver of all this. Now, obviously, people who follow Richard's work know that this is not correct, but at least for speculative markets, the market sentiment is heavily driven by this.
With regards to interest rate, I'm a bit agnostic on this. I think there's a lot of focus on interest rates on a daily basis almost. I mean, I just tend to ignore the news because they're just distracting you from important stuff. And when you look closer, the effect of interest rates on the economy is not very strong. I mean, I've been reading lately very interesting papers showing that actually when central banks increase rates in a strong way, this has the effect actually increasing inflation. It's called the Neo-Fisher effect. I recommend the listeners to check out the Neo-Fisher effect. And it's consistent with what Richard Werner has shown and has been saying for many years, that interest rates do not have a strong effect on inflation and economic growth. And actually they lag inflation and economic growth. If anything, the causation is from the economy to interest rates. In other words, central banks are behind the curve most of the times. And the interest rate tool is just very blunt. It's not very strong. I mean, yes, if they increased it to 30%, yeah, it would destroy the economy. But within the range that they move them, it's not a very powerful tool. And it's not driving inflation or GDP or anything else, I think.
That's interesting. But it does seem to have an effect on speculative markets, like, for example, foreign exchange markets, which is, of course, different from nominal GDP growth.
I mean, I'm sure the economy is a complex system. Everything is connected to everything. So I'm sure if you look closer, yeah, sure, interest rates have an effect. And so the asset prices have an effect on interest rates. Everything is connected. But when you try to, disentangle from the data, whether you can find a strong link, the link is very weak.
Yeah.
But you are right to point this out because we hear it every day in the news, and everyone focuses on the central bank and the next, FOMC meeting like yesterday or something. It's tempting, but what's driving the economy is not that.
Yeah, it's a big circus. Yeah, it is interesting to see the effect on other currencies. For example, when the Fed raises rates, the euro and yen lost a lot of value. It would be interesting to see if that's actually driven by rates or if there's anything going on behind the scenes.
But I suggest you do a different experiment. Take all the days when the interest rates are flat, are not moving, and are the currencies moving? Of course. So there's many factors.
Yeah, one of the questions from the chat is what effect do cross-border transactions have on the process of bank credit creation compared to domestic transactions?
Well, I don't know if you saw it. I had a graph there showing the balance sheet counterparts of money. And one of them, it's called net external assets of banks. This is basically the net claims banks have on foreigners. So this is the link to the current account, to the trade balance and the financial, the cross-border payments is through this element. The money held by foreigners is not counted in the money supply in most countries. So when euros, in the case of the euro area, when people bring euros from banks abroad to domestic banks, this creates money in the technical sense.
It creates money through the correspondent banking relationships?
Yes. Yes, it's money that already existed, but since it's held by foreigners, it's not counted in the domestic money supply measure. It's just a technical definition. You may argue it's arbitrary, but it is what it is.
It seems that a big limit on practical banking operations is the kind of the bandwidth of correspondent banking relationship channels. So how much credit they can have with other banks. I'm not a banker by profession, so I'm not sure what kind of criteria do banks use in determining this level of the nostro vostro accounts that they set with each other. So for example, if I'm UBS and I want to make a transaction to like another Eurozone bank, well, maybe Eurozone's not the best example, but if I want to make a transaction to another bank, obviously, my private money on my balance sheet has to be, converted to liabilities on the other bank's balance sheet.
So I'm not sure if I understand the question. I mean, the banks, as you said, the nostro and vostro accounts, these are just interbank accounts, and they are needed to settle cross-border payments. And banks hold them, it's just part of the business model. If they want to be part of the cross-border settlement system and charge fees, and if that's their business model, they will open an account at another bank and foreign bank, and the foreign bank will open an account with them. This is just a mutual, they make up these entries. It's very interesting how it happens. It's just, the foreign bank says, I will hold euros with you. So it's his asset and the liability of the Euro bank. And the Euro bank says, fine, I'll hold dollars with you. And they just make up these entries.
Yeah, but how do they determine the size of the entries?
I mean, I couldn't tell you because try searching for nostro vostro accounts, which I'm surprised you know. In Google, I mean, there's nothing. There's no papers on this stuff. People don't know about this stuff.
Yeah, indeed.
So it hasn't been studied.
Unless you work at a bank, it's really hard to find out. Well, you have to work in the treasury management department to really understand how this works. So I was trying to find out a few years ago because I was looking at how would you create like a crypto-friendly bank in some small jurisdiction and then tie it into the global financial system and really get this bandwidth of the channel with the correspondent banks. And I wasn't sure what the criteria are used to set this bandwidth. So if I create let's say if Bahadal sets up your bank in like Luxembourg, and then you want to create a correspondent relationship bank directly to, let's say, JP Morgan, it would be really interesting to see how they actually determine, what is the size of the mutual accounts, because it does seem like arbitrarily created money, but there must be some regulation determining this payment channel size.
I don't think so. I mean,
otherwise, a small bank, who's in like some weird country, could just like mint like a bunch of money and get a bunch of euros, which doesn't happen. So at least not that I know of.
If it depends on the size of the banks. If you are two big banks, as I mentioned in my example, it's supposed to be two big banks. They do hold accounts with each other. But if the relationship is between a big bank and a small bank, the big bank is always going to say this to the small bank, you hold an account with us. We're not going to hold an account with you. In other words, you give us funding, or you give us a liability. And
that makes sense.
And I should say, you mentioned creation of money through nostro vostro. It's rather more indirect because banks typically, some cases happens, but typically they don't give credit to each other by crediting nostro and vostro accounts. And if they do, it's very limited. They have a cap on the overdraft you can have and so on.
Yeah, because I have this experience working with the smaller banks, and they always kind of complain when you try to make a bank transfer, because I do think that they do have some kind of like hard limits on how much they can transfer. Yeah, it's something to kind of look into. But yeah, you're right that there's really no clear literature on the topic. I've looked at.
There is very little literature on both on the, and that's why I'm interested in this stuff in the mechanics of how cross-border payments happen. I mean, you kind of, it's hard to find just an explanation of the balance sheet entries of how this happens. It doesn't exist. And also another speaker earlier today spoke about, I forgot who he was, about custody and custodian banks and so on. This is also not very well understood. That is, people, for example, if you hold a bond or something, or an equities in a company, you think you hold them, but this is not. This would be in the 1970s, but this is no longer the case. You hold an account with a custodian bank, say, JP Morgan, and JP Morgan holds an account with a custodian higher up in the hierarchy, say Bank New York Mellon, and that bank holds an account at the CSD, the Central Securities Depository, where those shares are actually held. So it's just a tiered, a tiered relationship between accounts. So accounts are everywhere, not just in banking, but also in securities.
Yeah, indeed. It's quite a complex system. And that's
why another speaker talked about the tokenization of bonds and stuff. This is why it brings so many, it seems like a simple idea, but it brings so many cost reductions, because this industry is very tiered and there's a lot of intermediaries and the chain is very long and each charging fees and so on. So that's why it makes good sense to do these things.
Yeah, and especially in the cross-border case, you have to trust the custodians of other countries. So this is related a little bit to what Yamadera-san said this morning in his talk about he hinted a little bit at what the proof concept is that we're working with ADB on. And for cross-border bond trading, one country cannot affect, without a bunch of guns, they can't really directly affect a neighboring institution. And so if you can kind of automate some of this using blockchain technology, it opens up new possibilities, because you don't just have to trust people working at some desk in another country. You can have some kind of mathematical proof that you have it. Now, whether they pay you or redeem it in the end is a different story. But that's
correct. And we saw in the case of a couple of months ago when Russia demanded back its securities, and it turns out, no, the custodian said, no, your securities account is blocked, which is technically a default. I'm not making an argument whether it's wrong, right or wrong, but your securities are somewhere else. Russia does not hold, U.S. treasuries or something. It holds an account with JP Morgan, and JP Morgan hold the securities. So it's tiered.
So if you were to design a more resilient system using the possibilities of DLT and blockchain, how would you do it?
I tend to be very cautious and not to talk about things I don't understand. I mean, the stuff I talked about in the talk is pretty straightforward. That's why I sound confident. Maybe not, but it's something I would have to study, and then I could give you an answer. But I cannot.
Yeah, it's definitely not trivial. So it's something that we're trying to think about at SORA. Obviously, it's how can we design a better system, especially in the more degenerate use case. So like in some developing countries or countries that don't have strong financial system, or they're bankrupt, or different things like that. In these situations, you actually have a way to think about, how could things be structured in a better way, because you don't have all the legacy infrastructure. So that's something that we're thinking quite a lot about. I wrote this paper, The Case for ZOR, which is constantly evolving, and we're trying to think about how can we make ZOR useful as a supranational currency that can also do some form of so-called credit allocation for productive use. It's not credit, but the more I study it, the more I'm kind of thinking that debt-based system is not the right way to go, not because of the complexity of the liability framework, but rather interest. Because if you're a company and you borrow something with 10% interest, then you have to somehow this extra 10% of the money has to come from somewhere in the economy. And so it does create kind of a degenerated incentive model for financial institutions. I think that's one reason why many Middle Eastern countries that use Islamic banking practices have somewhat better social outcomes. I don't know. Do you have any experience studying this topic in your research?
No, I don't.
Yeah.
But I will say that the idea behind SORA, which is powerful and simple, and certainly, how do you say, endorse it. I mean, I find it very something worth trying. I was talking to Ben some months ago, and I realized I was thinking about this similar kind of stuff, like maybe 2015, but I didn't even know what Bitcoin was and nothing. And I was just starting to study economics, and I was thinking, why is currency so stupid? This fungible stuff. Why don't we design I call it networked money? Why don't we? And it's exactly the same, but it's because it's a very simple idea. Just do incentive, give subsidies or something to people who engage in certain types of transaction, and others will you maybe subtract from the money balances they have. And I certainly like the idea, and I think it's worth trying.
Yeah, it's all an experiment, but I do think that humanity needs to learn to collaborate more, and I think having a bunch of different currencies hurts that collaboration because there is this inherent financial competition. Speaking of that, one last question from the chat is who controls the central banks, Borja?
Well, I would say I would give a non-conventional response. I would say it's just ideas that drive central banks. People would say, oh, look at the shareholders, look if their central banks are private. I think it's just ideas, like everything else. Certain models, certain ideas in economic theories and so on. This is what drives central banks at the end of the day.
Interesting. There's the saying, people don't have ideas, ideas have people. So maybe it's that. Yeah. So I think we're at the end of your time. So I thank you a lot for the talk. I thought it was really enlightening, and it's very rare to have people actually explain these details. In fact, what we learn in school is very different fantasy compared to how things are in the real world. And even in our discussion now, trying to go into the details of like how cross-border payment channels work and how these size limits are made. All the details are really hard to find out.
So, they are. Yeah.
It's quite interesting. Looking forward to discussing this in the future, and maybe we can. I also reading more of your papers in the future will be quite interesting. When are you planning to graduate?
Well, I think it'll take me at least another 4 years. I'm doing it part-time, so
okay.
Because I have a lot of work at the same time. So yeah.
It's hard to do that extra push, I know.